Right now, someone is selling the exact stock you just bought. You clicked buy, they clicked sell. The trade happened in microseconds. But you have never thought about who or what is actually on the other side. Most people picture the stock market as an auction: real people, real desks, shouting prices. Maybe you picture Wall Street. That image is almost completely wrong, and understanding what replaced it will change how you think about every trade you ever make. When you buy a share, somebody on the other side is giving it up. Every buyer needs a seller. For most of stock market history, matching those two sides was slow, human, and chaotic. Floor traders, hand signals, slips of paper. Then the computers arrived. By 2010, high frequency trading firms were responsible for over 70% of all US equity trading volume. So, who is on the other side of your trade? Statistically, most of the time, it is an algorithm, not a person making a decision. A set of rules executing in microseconds, designed to profit from the difference between what you will pay and what someone else will accept. These firms are called market makers. They sit between every buyer and every seller, collecting a tiny spread on every transaction, millions of times per day. Here's something your broker almost certainly does not advertise. Your order often gets sold to a market maker before it ever reaches a public exchange. This is called payment for order flow. Your broker receives money from the market maker for routing your orders their way. The market maker fills your order at a price slightly worse than the best available, fractions of a cent. But across millions of orders, those fractions become billions of dollars per year. Sometimes the entity on the other side is not even trading your stock on purpose. Pension funds and hedge funds often trade entire baskets of stocks to rebalance a portfolio. And sometimes the other side simply knows more than you. But information asymmetry is baked into every market. Institutional investors have research teams, satellite data, credit card transaction tracking, and tools that scan every earnings call for vocal hesitation. A retail investor with a brokerage app is showing up to a chess match against someone who has memorized every game ever played. Every time you try to outmaneuver the algorithm, you are more likely to feed it than beat it. But here's what the algorithms cannot do: they cannot wait. They are built to move. Their entire edge evaporates the moment they hold a position too long. Your edge, as a retail investor, is time. It is the one resource they cannot buy. In the short term, the market is a voting machine, reflecting noise and the moves of large players. In the long term, it is a weighing machine, reflecting the actual growth of real companies. The entity on the other side of your trade is faster than you, better informed in the short term, and completely indifferent to whether you profit or lose. It is not personal, it is a system. And once you understand the rules of this system, you stop trying to beat it at its own game. Right now, someone is selling the exact stock you just bought, and for the first time, you know exactly who that is.